we need to find some things to talk about that aren't a total bummer.
Yeah, that's true.
Because the meat of today's show is Iran, mass layoffs, and potentially a student debt bubble.
Well, we got Pikachu.
So we got Pikachu. That was right. So I did a story for The Indicator from Planet Money about the Pokemon card boom. I sent it to you, so I hope you were able to check it out. Sometimes you hear a version of it on this show, and then it turns into something else.
By the time this publishes, I will have listened to the Pokemon episode.
It's 8 minutes long. These shows are like an hour. This one is 8 minutes long of fact-checked reporting. But anyway, some of our listeners checked it out who aren't Malcolm. And Peter C. hit me up on LinkedIn. And I always enjoy getting messages from listeners. There are some things that are better to tell us in a private message and some things that are better to tell us in a public message. And to be clear, one of the reasons I give my LinkedIn at the end of the show is because if you have constructive ideas or feedback, messaging me on LinkedIn is a great way to get those ideas across. But anyway, Peter C. messages me and he had a question that we'll probably hit in a future show. But he's also sent a photo of him and his fiance, which I found a little bit unusual. I was happy to see it. I like seeing our listeners and where they're listening to shows, but not too many people send a photo of them and their fiance. And I was like, oh, is this your fiance or wife? And he goes, yeah, it's my fiance. And I was partially able to afford the ring I got her because of selling Pokemon cards. And I was really happy to see, I'm like, this is the best way to cash in on a boom like this, is to use that money for something like that.
Can I back you up for 1 second? So there was no text. There was just a picture of two people standing there smiling.
He had a question associated with it. So I don't know if I interrupted him before he was going to give the context for the photo. Got it. But he had a legitimate financial question for the show about geopolitics, which I'm sorry, Peter, we're doing a lot of geopolitics today. So I'm going to leave it for another time. And then he sent the photo and I was like, basically asking for context. And he said, I was able to get engaged. Part of the ring was purchased through selling Pokemon cards.
Yeah, I'm glad. Okay. I was worried for a second that to me, I would have been like, what is this person trying to proposition me to do? Just sending me a picture of them smiling and no text to go along with it. That's what I get for being online. I should have been somewhere else. That would have been my initial thought, but I'm glad you clarified that it was more about
Malcolm. It was him and a female partner showing off a ring.
Yeah.
So it was clearly like a sort of engagement shoot.
Yeah, but if I don't know you, that could have been AI generated and you were just sending me a message to get me to respond, to then steal my identity, to then steal my Amex card. That's where my brain goes. I assume everything that happens to me online is a scam until proven otherwise.
Okay, I'm sorry, Peter. I know you listen to this show. You've listened to the
this is nothing. This has nothing to do.
We've
with Peter
had previous messages about the show.
Yeah,
and he was kind enough to offer feedback that was relevant to the stories I've been covering that you have not been listening to. That I have to repeat for you right now. And
listen,
you're accusing this guy of being an AI scam.
No, I'm telling you. I am glad that you clarified that there was more meat on the bones here, because my reaction was, oh no, Ricky's going to get his organs harvested and he doesn't even know it yet. That was immediately where I was concerned for you, my friend.
My organs harvested? Are you in an okay? I mean, I know we've got some heavy stuff to talk about.
I'm telling you, listen, there's a lot of scamming going on online. And so that is where my brain jumps to when people send me unprompted messages that include just very innocuous, calm, simple, wholesome looking things like a guy and his new fiance smiling, happy about their engagement. And then you say, oh, congratulations. And they say, thanks for your social security number. Now we are going to go purchase $20,000 worth of Pokemon cards with your American Express card. That's the linkage that I'm seeing.
All right. Well, if you want to try to scam Malcolm, our email is thistimepod@gmail.com. That's also a great place to send us normal questions and feedback about the show. Like Canada's place in the global economy, which is what the question was about and why I trusted that it was real.
Let me go back real quick. I want to go back to something that you said that actually is important. The nonsense aside, using the cards and the value that they created over time to do something tangible so that they're no longer just paper value on paper, these cards that are sitting in a shoebox or in a safe or wherever you have them in your house, to me is always the best thing to do with highly appreciated, I want to say securities, but it's collectibles in this case. And
it's not a security.
Yeah, the reason I'm making that case is because a lot of times people will just like sit and admire the thing until it finally is no longer even worth the thing anymore. Like a wine collection, for example, when you find out that that wine is no longer either worth what you thought it was or people don't care anymore. And so now like you can't actually turn that thing into real money. Doing something tangible with these things is always the best possible solution, because then whether the market for Pokemon cards goes up or down, you don't really care, because you get to look at your fiance, who then becomes your wife, and whatever you all do from that point, kids, buy a house, move to Japan, whatever you're going to do as a couple, couldn't have happened or wouldn't have happened on the timeline that it did had you not done the thing and turned Pikachu into $10,000. So that's more where I'm going with that.
That was not where you were going to begin with. I'm glad you put on your financial planning hat to say something nice about our listener and also offer an antidote to FOMO with these types of things, because yeah, then you're not staring at the card, seeing that maybe it went up another 500 or $1,000 and then regretting it. No, you have something wonderful and tangible. Congratulations, Peter C. I'm glad you wrote into the show. Anything else that's not a huge bummer that you want to talk about before I get to war and mass layoffs?
No, I just hope you haven't turned Peter C against me, because I was concerned for you, and now you made me hostile toward Peter C, who I've never met.
All right, so we're going to hit the Iran war, because that's the biggest economic story right now. In my view, there's mass layoffs at Oracle that may be tied to an OpenAI deal. And then student loans are starting back up. That is an, I think, undercovered story that is very relevant. Let's hit it after this. Malcolm, we are recording this on Monday afternoon, so anything could happen between 2:20 p.m. Eastern time and when this show comes out at 4 a.m. Eastern on Tuesday morning. Trump just had a press conference, and it seems like this deadline we had for Iran to do a ceasefire, they are not biting on. He went to a press conference today to talk about finding the missing downed pilot, saying, quote, the entire country could be taken out in one night, and that night might be tomorrow night. So much of this is coming through posts on Truth Social. Obviously, we're going to talk about the financial and economic implications, but feels like things are spinning out of control a little bit.
That's an understatement. Like, I don't mean to laugh. I don't mean for it to sound like I'm making light of the situation, but what an understatement. This clown show has gone so far off the rails that I don't even know how you get back in control of it, in all honesty. Like, I don't know what the path back looks like now, because you've done so much so fast. And we're talking about a group of people, geographically, socially, politically, whatever, Iranian people, have proven to you time and time again for the last, 20 years, that it doesn't matter how much bluster you use toward trying to quote unquote negotiate with them, they will not be bullied, is very clearly the message that the people of Iran have said to Western countries time and time again. And what I'm basing that on specifically is how many different accords have been struck over the last 20 years to dissuade them from developing nuclear weapons, all the different agreements, all the different carrots and sticks that have been lobbed in that direction. And they still keep on enriching uranium and finding places deeper and deeper underground to store it. And so I just feel like the people of Iran have proven to you that this isn't the path that's going to get you to where you want to get to. And so now we've gotten so deep into this thing that I can't even see what the path back looks like.
I agree. I can't make predictions regarding war because some of the predictions you make often don't come true. We know historically that political leaders are often rosier and more optimistic about how short a war will be, how much it will cost at the outset of it. But maybe there's a way we can pretend that we had a great victory, but Gulf states aren't wiping them out. Doesn't seem like there's a lot of alternative political leaders coming to the table to replace the lower ranks of this regime. And I mean, parts of it we weren't even super prepared for. If we knew this for months and months in advance, one thing we may have done is boosting the amount of oil we had in our strategic petroleum reserve. That would have been
because it already
nice
wasn't
idea.
full to begin with.
That's right. So there's parts of this that are just so sloppy that I understand why people are not even understand. I'm worried about it. It's not good. You even have the president now. Imagine this is a political attack ad. Quote, it's not possible for us to take care of daycare, Medicaid, Medicare, all of these individual things. They can do it on a state basis. You can't do it on a federal. We have to take care of one thing, military protection. We have to guard the country. We can't take care of Medicare. Imagine that on a local news commercial, Malcolm.
Well, also, the guarding of the country is always a priority. Right? That is always, as an American citizen, one of our top priorities. However, I would argue that it has become more of a priority since you started attacking people, right? Like, we're also talking about one of the top 5 cyber powers globally outside of the United States. So you have Russia, China, Israel, North Korea, and Iran. Those are the 5 strongest cyber attackers around the world, and we've agitated them. We're threatening to basically wipe them off of the map. I think that's a direct quote, actually. And what does that do other than put your back against the wall and say, well, we can't necessarily send a nuclear warhead halfway around the world to take out a portion of your physical infrastructure. But what we can do is literally turn your lights out with the flip of a switch. And that makes us significantly less safe than we were before this whole thing started. So now you're saying we have to spend more money to guard our country. But the reason you're having to spend more money to guard our country is because you spent a whole bunch of money to start this war in the first place. And so it just flies in the face of anyone who ever makes the case, we can't afford healthcare for all. We can't afford to make childcare affordable. We can't afford to make college affordable. We can't afford. Like all these things that we somehow can't find the money to do. It's an embarrassment of riches when you look at how much money has been dumped into 1 month of fighting this war that literally no one but one person actually wanted.
American markets have held up remarkably well. If you just knew all of the information without market performance, I would say American markets have held up remarkably well for this. It's not a guarantee, though, that this systematic distrust doesn't come to bite us in the future.
Is there anywhere you personally, as a person who watches the markets, are looking to go at this moment? I think you're making an interesting point that maybe we should spend a couple seconds on. S&P 500 is maybe 500 points off its all-time high. Not a huge swing given all of what has happened this year. We've been below the 200-day moving average for less than a month now. I think it's been like 2 weeks. And so the expectation is we'll move back above it and keep pushing back towards 7,000 like nothing ever happened. Given the fact that not a lot has gone terribly wrong for the S&P just yet, anything in particular you're looking at doing or not doing as an investor who watches this?
It's more not doing. I mean, to your point, I like looking for places where the story is broken more than the fundamentals are. Mm-hmm. We've talked about that with the software trade. Still looking at precious metals just because that's the only place a central bank can really go for a basically a tier 1 asset that's not a US Treasury. But I don't have a secret or magic sauce right now to give you. I wish I did.
No, I mean, but that could be the answer. Like, it's top of mind for me right now because I'm in the middle of rebalancing a lot of model portfolios, a lot of client portfolios. And the thought that I have is maybe we've been given a window where we can actually do something, because it looks like this is going to drag on a little bit longer. I know that the fear everybody has is the moment I zig, the market is going to zag, because the president will figure out a way to message to everybody that this is all going to be over soon. And as we just talked about, it's becoming more and more apparent that this isn't going to be over as soon as he hopes, because a whole bunch of reasons we just said. So the place that I'm looking at right now is commercial real estate. I feel like the commercial real estate sector has already gone through its recession and had its washout. And so it's less likely, unless interest rates go up significantly from here, which probably won't happen. They'll probably sit still, more likely than go up from here through the end of the year. And so that seems like a place to me that you could hide out a little bit rather than taking the ride with the S&P for the foreseeable future.
So are you looking at ETFs or big players like Prologis? Where are you?
Both. We're in an open-end fund from Cohen and Steers that is the majority of the real estate exposure, but then also digital realty, DLR, is another piece where we overweight into the data center space, since that's where a lot of money is getting dumped right now when rents are going up and they've got all the pricing power in the world. Prologis is another good idea, because assuming we are not going to stop ordering things to our homes anytime soon, again, pricing power, they're going to be able to increase rents. They've also got like a 95% plus, what's it called? Like lease through. I'm missing the term that I'm supposed to be using as a real estate investor, but you know what I mean? 95% of their properties are leased. So like looking at Prologis, looking at the data center space, things like that, to me, seem like a good place to be to avoid whatever negative shock we could have in the markets. And it's interesting that since this whole thing started a month ago, we've given up about 4% in the S&P, not nearly what you would expect it to have been, considering all of what is going on.
Okay. So yeah, Class A office space, that could be a good one to look at too. Anyway, I was trying to look up a company that I had invested in that was in the real estate space, but I wanted to make sure I can talk about it cleanly.
Sure.
Without suggesting that this is something that other people should follow, just because I hadn't checked in on it.
Without forgetting things like the occupancy rate. That's the term I was reaching for. That's
occupancy rate.
Yeah.
There you go. So anyway, let's get to big tech.
This episode is sponsored by Capital Area Planning Group. Capital Area Planning Group is a fiduciary wealth management firm that specializes in helping high net worth individuals and families navigate the complexities that come along with managing concentrated stock options, multiple income streams, and an ever-changing tax code. While our team of certified financial planners are well-versed in all things personal finance, our areas of expertise include equity compensation, estate planning, and multi-year tax planning. At Capital Area Planning Group, we believe in pricing transparency. That's why our fees are posted on our website, right alongside the various services we perform on behalf of our clients throughout the year. If you're tired of receiving the same cookie-cutter advice from your financial advisor, then don't wait. Reach out to us today at capgllc.com to experience a better approach to wealth management. Again, that web address is www.capgllc.com.
I mean, the biggest news with this is that Oracle has laid off 30,000 people. Some of this may be tied to the $300 billion that OpenAI is supposed to spend on cloud and data services from them. That's leading to this massive debt-fueled build-out. And investors, especially debt investors, seem to be losing some confidence in Oracle. But I mean, you talk to tech workers on a daily basis. Any broad reflections on this? I mean, it's a bloodbath at Oracle. 30,000 getting pink slips.
Yeah, so I actually know people personally who have been impacted by the Oracle layoffs, and I can tell you, literally everyone that I've had a conversation with was blindsided. Oracle employees were under the impression that things were good, and the messaging internally has been, don't listen to the outside world. They don't understand what we've got going on over here. We're killing it. We're going to keep killing it. Stay calm and carry on. And all of a sudden you get this announcement and you're like, whoa, wait, what? And wait, me? And so it's interesting that it seems to people involved like it's somewhat out of left field. But I'm looking at the announcement from Oracle. I'm also looking at what's happening with OpenAI, which we can get into in a second. And it makes sense to me. Like Oracle's got to figure out a way to cut as much of their spending as possible before their debt load catches up with them. So by cutting these 30,000 jobs, they're expecting something like $8 to $10 billion is going to be their cost savings on an annual basis once they digest the severances and everything else that go along with it. And that's because, one, to your point, they're concerned that these RPOs maybe aren't actually going to pan out the way that they had hoped. But then also,
well, one thing to watch with this is how debt investors are reacting to Oracle right now. Bond investors can tell you the truth. 2015, Oracle was issuing these, I guess it would be like a 40-ish year bond or 30-year bond, excuse me. So issued in May of 2015, comes due 2045. They're able to issue it at about 4.4%. Now investors are demanding about 7.2% for those bonds. For anything long-term that Oracle is trying to issue, it's above 7% that investors want in terms of yield. So this messes with some of the par values, but yeah, for some of their long-term stuff, I'm seeing some close to par, but then some, and by par, I mean, is it trading around $1,000 where these bonds were issued? Some of these bonds it's 61%, 61% par. Some of them are above that. You look at some that are more recently issued, 95%, 85%. But investors seem to be saying, no, we want basically junk bond payments for your long issued bonds from one of the biggest, baddest tech companies in the United States.
So that's what I was saying about them trying to find ways to reduce their costs before their debt service completely takes them over. Essentially, too, we're trying to make this giant switch from a legacy tech company, a software company, to basically a data center landlord. And that's a completely different looking business from what Oracle has been known for all these years. And so there's a lot of remaking the company and remaking its business happening internally. So it's not a surprise to me as an onlooker when a company's stock has gone parabolic the way that it has, all in 7 months, maybe? I think it was September when the announcement from the $300 billion came through, and then Oracle's share price spiked above 300 and then fell back down to earth. And then now, where are they, like 150 or something? I'm blanking because I haven't seen it today. But it's been a round trip.
145.
Like, geez, like that's also part of what doesn't surprise me, that they looked internally and said, we got to start cutting here, whether we're ready or not, whether we can actually deploy AI within the business to help get us more productive to replace these workers. We're going to blame it on AI. But in reality, we need $8 to $10 billion that we were going to pay these people every single year to help service our debt. And we hope to God that we can use AI internally to help make up that deficit.
And let me, I want to add some context to the debt servicing, because for a long time, tech companies were able to get really cheap debt, especially through the 2010s, early 2020s. And they're able to use that for these build outs, which is that we can get money cheaply. And there's two things that are kind of in combat here, which is one, OpenAI has basically taken out a lease for an apartment and said, we promised here's the check, but investors are saying, we don't know if that check is going to cash, which is why for your really long dated, and Oracle's is issuing like 50-year bonds right now. For the ones they've issued in the past, they're saying we have significantly less confidence than the interest rate you gave us. So now at this point, when Oracle goes to the debt markets and says, we want to issue more debt, and granted, they said we're not doing any more this year. We'll see how things change in the next 12 months. They have to go to that 7%, which makes the cost of money way more expensive than what they were used to, than what their plans were. So Number one, it's more expensive to do these debt-fueled build-outs, and the cash flow that's coming in to service that is more uncertain from investors. So that's why this is the moment of truth, I would say, within those debt markets.
One thing I'll say to the point you just made about tech companies used to be able to go out and get really favorable pricing on their debt. Mm-hmm. The rest of the tech companies still can. We just saw Alphabet, Google issue a 100-year bond, and they were oversubscribed. We saw Amazon raise, I think, $50 billion they just did in a debt offering a few weeks ago, and they were oversubscribed. So it's not necessarily that tech companies across the board aren't able to command the prices that they want to see. It's that this particular tech company, and I would even argue Microsoft probably belongs in the same camp because of the level of exposure and dependency to OpenAI. All of this started, I hate to bring up old stuff, but I will.
Bring it up.
All of this started because Sam Altman didn't like a question from a longtime investor on a podcast in public, and he responded like someone who didn't have a care in the world.
Oh, there's so many. I want to start a PR training firm. It's so easy. You just care about the person and then dodge. I know. Anyway, go ahead.
But
did you have
no?
All right, that was it.
Anyone who's listened to any of our previous shows knows exactly what I'm referring to. We don't have to relitigate that here. But I'm seeing this through line happen week after week after week, where that one interview and the connotation that came from it has had this ripple effect through the entire market, and it didn't have to be this way.
All right, let's get to the manifestation of that, which is that Next Round Capital founder Ken Smythe, this is from a story by Bloomberg's Hema Parmer, he says that he's had about 6 institutional investors approach his company in recent weeks looking to sell about $600 million worth of OpenAI shares. Here's the key quote. "We literally couldn't find anyone in our pool of hundreds of institutional investors to take these shares," said Smythe. Buyers have indicated they have $2 billion of cash, but they want it to go to Anthropic. So these big money institutional investors seem to be going to Anthropic, losing confidence in OpenAI. But here's the question I have for this, which is, if you are selling, just from a gamesmanship perspective here, if I had shares of OpenAI, why am I telling Bloomberg that I have nobody to sell it to? So either there's more going on, or this guy could be one of the worst salespeople in the world.
Well, it might be that it's so dire that I feel like I have no choice but to start talking out of school. Like, it could be that it is worse than we think it is. And the only way I'm going to find a buyer is to shame this company into turning it around.
Okay, maybe that could be it too. And an OpenAI spokesperson went on X. I couldn't find out who this person is exactly, first name, last name, but he seems to be speaking on behalf of OpenAI, and people seem to be responding that way. He does not have his first and last name. It is at CPMOU 2022, saying, quote, "The premise here is false because OpenAI has protections to shield consumers from unauthorized secondary sales as outlined on our website." Little bit of a bank shot response. Doesn't really mean a whole lot. This guy says he can't sell it. I don't think the buyers are not picking up these shares because it's against the rule.
Yeah, I mean, if you want to find somebody to sell your shares to, we heard how quickly and how glibly Sam Altman said, you want to find a buyer for your shares, I'll find you a buyer, Brad Gerstner. So we know that it can't be that hard, right? So I think that was a nice attempt at a dismissal. But in reality, OpenAI, other than SpaceX, was the most hotly anticipated IPO last year, coming into this year. It was going to be the biggest, baddest IPO we've ever seen. And so to imagine that there's a world where there's not a secondaries fund, especially with all of private credit turning sour and the private equity world turning sour right now, you don't think there's a private equity fund out there with dry powder that would love to buy those OpenAI shares this close to an IPO anyway? So it's, you've got embedded return in there. So it's unrealistic to say, like, there's no truth to what this person is saying.
Or we start up our own ETF. We could start up our own AI ETF, and we're going to dump in some losing companies and then a special purpose vehicle for OpenAI shares that we're able to pick up from Mr. Smythe. Why wouldn't we do that? Easy money. Anyway, you got to the point of the IPO. OpenAI execs are now split on whether and when to IPO. This is in the information. And it's getting to a weird place where now I guess Sarah Fryer, the CFO, is saying maybe we should delay. Sam Altman is excluding her from meetings with top investors, reporting from the information, not from me, that he is excluding his CFO from conversations related to the company's financial plans with top investors, which seems a little odd. Also, the CFO doesn't report to Sam Altman at the company, which is kind of a question mark. But yeah, that could throw a wrench into AI enthusiasm if this company keeps kicking the can on IPOing.
This is once again sounding very WeWork-ish, like very, very WeWork-ish. Like you exclude your CFO from conversations with your largest customers and shareholders. Like what? But let's go back to 2025 again. Sam Altman makes the comments he makes, I think in September of 2025. And then in October of 2025, Sarah Fryer's on a stage at a conference. And someone asks her about an IPO. And she says, I don't think there's a chance you're going to see an IPO this year or next year, referring to 2026. We may not have to IPO if we don't want to. Something to that effect. I'm trying to recall from memory, but it was basically that. You ain't getting an IPO is what she said. So she's held firm in her stance, even though publicly Sam Altman has said, no, we're going to have an IPO. They just finished this large capital raise that was over $100 billion because they needed the additional capital to get their next round of spending commitments taken care of. So it made sense that they would need to IPO because it's like the last place you can go to tap big enough money to do all of what you need to do. But it sounds like she's saying, now keep in mind, this is an experienced CFO who has worked as a CFO for several other tech companies. She is saying, without saying it, I'm just trying to interpret the words coming out here. I have seen enough to know this company is not mature enough and is not ready for an IPO.
And so to be clear, one of the things we're talking about is that they can't get rid of shares.
Mm-hmm.
And that is something that the CFO may be saying, that this company is not mature enough for an IPO, or we're worried about adding more investors to the pool and how that plays with our valuation when we're not just selling to Masayoshi Son and large tech companies that we have deals with. But on the other side of this, 8 hours ago last week, Sam Altman closed a $122 billion funding round,
mm-hmm.
the largest venture capital deal ever. So some people are saying they can't get rid of shares. Altman has no problem getting money for his company right now.
I disagree. I think that was the last gasp. I think Amazon kicking in, I think NVIDIA kicking in. I think Microsoft even at the last minute came and decided to throw some more money into that deal. But most of it was Masa Son selling off his best assets to get cash to put into OpenAI. Masa Son is always the last dude into the room. So whenever SoftBank goes all in and pushes its chips to the center of the table on an opportunity, that is the last big money raise you're going to get to do. So I think an IPO is the only option this company has after that. Like Kathy Wood might come along and sprinkle some more dollars on this thing. But between the two of them, those are usually the last dollars into a deal.
So let me finish up with some context. The reason this is a big deal for even regular investors who aren't planning on buying funds into the OpenAI IPO, the more they delay, this causes some of the air to go out of the AI story, propping up the economy, which could have material effects for other companies involved with it. Is that fair?
Oh, for sure. But I think the opposite direction too. Anthropic seems ready to go. Yeah. Like they've messaged to the world that they are preparing themselves for an IPO in Q4 of this year. And that's not like we just happened to get that information as a leak. That was like intentionally messaged to the outside world. And so what could be happening is Anthropic is overtaking OpenAI because they decided to do more with less early on. And they decided to focus on the enterprise early on instead of going consumer facing. And OpenAI is having to walk back a lot of the investments and products that they built for the consumer, trying to get now to where Anthropic already was. So all of the excitement over Claude and Claude Code and co-work, and it's going to basically destroy the need for all these other software companies, the SaaS apocalypse that's been happening, is all because of Anthropic. And so they couldn't have a better time to be IPOing right now, even though the market cap they're planning to come out for is much lower than OpenAI's. I think that could be detrimental. That could be devastating to OpenAI if they truly are not ready to debut this year.
And importantly, Anthropic has a different capital allocation strategy than OpenAI that I think is worth highlighting. Dario Amodei has talked some trash about the way OpenAI is, doing these hundreds of millions of dollars financing commitments for data centers that may not materialize for 5 to 10 years down the road. And Amodei basically saying, if if demand is 5x, but you've spent for 10x, that could be catastrophic for your company. And they're going a bit more bit by bit, it seems. But I think that's also something that investors may be liking, other than just which horse is better in the race today. Last thing we'll say on this is you shared the story from, it was November 2025, which is forever ago. In the AI world, it's from Business Insider. Companies are warning about risks of AI in SEC filings. This includes Figma, Workday, HubSpot. They've downplayed the threats that AI could crimp growth, a concern that has pressured their stocks for months. So far this year, 27 software firms, including the 3 mentioned above, has described AI agents as a competitive risk in their securities filings, up from the 7 that disclosed such risks in the same period last year. This came out in November of 2025. Why is it a big deal in April of 2026?
Well, so Business Insider first covered it in November of last year. Then the information picked it up more recently, I think 2 or 3 weeks ago. And now we're rolling into Q2 earnings season. And what I am watching for and will be listening for is if that number of firms goes from 27 to 50 or 60 or 70 or 80 because of the SaaS apocalypse that has happened to us, where you have these companies that are on one hand going on CNBC and other places saying to the world, AI is not going to disrupt our business that much. There will still be a place for us. And then on the other hand, in their securities filing saying, oh my God, AI is going to ruin our business. Please help us. And I'm just curious how this thing shakes out, where you have on one hand, you're saying this publicly, and the other hand, you're saying this in not confidential, but quieter filings that no one's really paying enough attention to yet. I'm curious whether that brave face is performative or whether it's true. Now, I know it's 2 separate things happening simultaneously. You'll have a group of CEOs that really believe wholeheartedly in their business and there's nothing you can do to shake them. The example that I'll use is Nikesh Arora, who just threw $10 million of his own personal capital at buying additional shares of Palo Alto Networks because he was like, absolutely not. You guys are missing it here. And I'm putting my money where my mouth is. But on the flip side, you'll have a bunch of CEOs of companies, I won't call any of them by name, but companies that were just mentioned here, like Figma, Workday, HubSpot, like part of that 27, I want to see if it goes to 50.
And the other thing I think you mentioned, which is the open market, it was the Palo Alto an open market buy?
Mm-hmm.
Okay, so something to watch with this is not just what are the disclosed risks that they're saying in their filings, but is the CEO and especially the people under the CEO making open market buys? Are you seeing board members take money out of their own pockets because they think this stock is undervalued? Or, your chief marketing officer, your CFO, people who are wildly wealthy, probably by your standards, but still making significantly less money than the CEO. So I think that's something I'm going to be watching this earnings season as well. One other thing I wanted to talk about with you is student debt. I think this is a huge economic story that is going to come up more in July, which is when the SAVE Act is basically no longer in existence. There's a story in the New York Times called "Student Debt Burdened Them, so they moved abroad and stopped paying." There's some odd stories in here, primarily that there's a lot of people not paying their student debt in America right now. So maybe you didn't have to move abroad. However, this is the stat that has my eye. There are more than 40 million borrowers saddled with federal student debt. 7.7 million have defaulted on their loans. This is according to data from the Education Department. This is a higher default rate than subprime mortgages in the 2008 mortgage crisis. So a little bit of a different comparison because it was mortgages, and this was Federal Reserve data, mortgages that originated in 2005 that were subprime. And this is across the board student debt. So there's a little bit of a timing discrepancy, but I think that the point I'm making hopefully is salient, which is that we are at basically California subprime mortgage levels for student loan defaults right now. At the same time, those payments are going to ramp back up in July. This is a huge problem.
It's amazing to me, though, that we can't agree that this is a crisis, because we're having a conversation. America's really good at like having a conversation about a problem and how to diagnose the problem and how to medicate the problem without accepting the fact that like prevention needs to be also included so that we don't get to the same place again. And all of the conversation we keep having at and around each other with these political cycles, you know, midterm and then the presidential election around, we need to have more kids in this country, and people who are of kid having age saying, I can't afford it, leave me alone. And we need to have more homes purchased in this country. And people are of first-time home buyer age saying, I can't afford it, leave me alone. And this is another example of one of those things where we're like, we need more college educated men specifically, because women are going to college and graduating at a rate like 2 times as much as young men right now. And so we're looking and saying, what is happening to the young men? We're leaving behind our young men. We need to get them educated and through college and blah, blah, blah. Well, maybe part of it is I can't afford it, leave me alone. Like 19% of student loan borrowers are delinquent now. That says a lot. Like, it's not just that people don't feel like paying. People typically want to pay their bills so that they aren't delinquent and don't have 200-point dips in their credit score and can't do other things, right? Like, not everybody, but generally, I would assume that's the case for people. So, like, we're having these conversations at and around each other about the cost of college on one hand, also student loan interest and the way that it builds on top of you and the fact that it can't be discharged in bankruptcy and everything else. So I'm not saying that I have the answer necessarily, but I am saying that we've got to stop pretending as if this is not a real crisis, because it is keeping a lot of the same people that we are looking to and saying you should ... by this point in your life. This is probably a big portion of the reason for a lot of people why those things haven't happened yet.
Well, on the other side of prevention, a student loan is the only thing, it's the only debt you can take out without trying to track how you'll pay it back. And I think that's a part of the, 3-2. Well, the other part of this is that a student loan is the only debt you're allowed to take out really in a significant portion without any thought on how you'll pay it back, how degrees bring in X amount of income and that sort of thing. So you're leaving people who are maybe 18 years old, not in the best place to make large financial decisions, high and dry. And the way that this will work is that when the SAVE Act goes away, 7 million enrolled borrowers. One example that Business Insider found, Ashley Group, her monthly student loan payment, they've been $54 for the past 3 years. This fall, they will likely surge to over $600. She's working on water quality for the state of Missouri and has $76,000 in outstanding student loans, 2 degrees in environmental science. So this is important because This person has real professional skills, is doing something that is needed for society, and will say, I cannot pay back these student loans. You need people testing your water quality if you're someone who drinks water.
All right. I said I didn't really have a solution, but I think you just reminded me of what the solution is. I think the exact same student loan forgiveness program that the Trump administration just threw in the trash should actually be the focus, where if you are a person who decides to go study something that maybe doesn't make a ton of money because it's for public benefit, not for capitalistic benefit only.
Sure.
Work in that arena for 10 years, get those student loans forgiven, right? We just went through that cycle with the Biden administration where I saw people who are attorneys with law school loans who choose to work for federal agencies or similar, environmental organizations or whatever, have their student loans forgiven because they chose to make less money to do something that's a noble cause. I've seen physicians who have chosen to work for hospital systems where they serve the general public instead of hire in wealthy folks who have health insurance and can afford, who have access to better medical care. And they've gotten their student loans forgiven because they're doing a public service instead of going and making the maximum amount of money that they could make. Like, I think that is the solution. If you choose to go do something that helps society, we will offset your student loans so that you can go and maybe do the next thing that you want to do that makes more money, or just keep doing what you're doing.
I have two solutions. One, I think you need to do a gradual, you need to do a gradual step up in terms of repayments. If this is where you're going, you can't go from 50 to over 600 for most people and have them just be able to absorb that, especially when they're working class. That's totally unacceptable. You need if you're really hell bent on reintroducing this, you need to do a gradual step up over 12, maybe even 24 months. So people can figure it out, because I understand loans need to pay back. You can't have people going delinquent on them, but also it needs to be done in a way that folks can digest a little bit. It's also not perfect because it's still at the same place. It just gives them more time. And the second thing is on the loan side. When you get a student loan, federal or private, there should be an actuary who is able to go in and say, what is the degree you're getting? What is the average cost of college per year? And what is the median salary 5 years down the road coming out of that? So if you're and just set a limit based on that, and maybe based on your parents' income if you really want to do it that way. But
no, you can't assume that mom and dad are going to kick in.
For plus loans, yeah.
Sure, but I'm just saying, like, you can't assume that. You can't go based on mom and dad's income, because, like, I had an econ professor in college that was like gladly letting the world know all of the reasons he had devised on this chalkboard of why it was not in his best interest to pay for his daughter to go to college, even though he could have cash flowed it with no problem. Like, can't assume.
Okay. With respect to your college professor, I agree with him, maybe philosophically, maybe not.
No,
I need to look more into it. I think that dude is nuts. I don't know why I said that. I don't think I agree with him. If you can help your kids through college, do that. Don't saddle them with debt. What was I saying? We're getting late in the show. But a parent plus loan is fundamentally tied to a parent's income, right? Mm-hmm. Okay, so then you take that into account with the loan you're doing, if that's your backstop. If David Ellison is taking out debt for Paramount, they're looking at Larry Ellison's net worth and income. The same is true on a smaller scale for college. So anyway, this is a huge economic story. We'll continue to talk more about it. Let's leave it there. I'm at Rick So Slick on Instagram and X. You can find me on LinkedIn, as I plugged at the top of the show. Malcolm is at Malcolm on Money. Appreciate you listening, and we'll see you next week.
Information shared in this recording and by its guests represent the views and opinions of the guests and does not represent the views or opinions of the host. This content has been made available for informational and educational purposes only. This content is not, nor is it intended to be, a substitute for professional financial advice. It is always recommended that you seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your personal financial situation.